How do you invest in times of inflation? Driving during rains requires a very different skill and preparation. Likewise, investing during times of inflation needs a different strategy. When you receive your salary, you first pay an income tax, say 30% of your income. So from rupees 100 income, you only receive rupees 70 after deducting 30 rupees towards income tax. Now when you make a purchase of 70 rupees, you also pay 18% tax, which means you actually get worth of 60 rupees only. So from 100 rupees income, you are effectively able to use only rupees 60 because you're taxed twice, once as income tax and another time as GST. Now over time, the cost of goods increases due to inflation. So now you get lesser for the same money. You end up spending more now, that is rupees 70 for what was rupees 60 earlier. Now let's say you cut your spending or you get a salary hike, you pay taxes and manage to invest rupees 30, it grows to rupees 60. You will now have to pay capital gains tax and dividend tax to take home the profits you made through investing. It's a jinxed curve. This unholy union of taxation and inflation pushes us into what we call the unaware poverty. This is what is referred to as misery index. We think we are getting richer, but inflation and multiple layers of taxation are invisibly pushing us behind. If you make 10% return on your investment, and if inflation is running very high, then the real return is zero. Only when your investment returns can exceed this misery index, you make real returns. Purchasing a flat is an expensive proposition. Inflation has pushed it beyond means. If steel and cement price increase has caused inflation, then why not invest in the stocks that make them? You're not only protected against inflation, but benefit from it. This is a simplistic idea. Investing in inflating commodities and assets can protect our money from inflation. Stocks have outpaced inflation, as you can see in this chart. Even during high inflation times, equity funds have been able to beat inflation, but it comes with a risk. A less riskier option is to invest in value funds, those that buy stocks that are underpriced or with high dividend yields. Companies associated to value stocks borrow less money from the banks to run their business, thus lowering the interest burden during high interest rates. Real estate investment trusts or real estate or gold are also known to protect against inflation. This is because gold and other metals are real tangible assets. Their supplies are also limited. However, the performance of these assets vary due to global economic factors, and retail investors can find it difficult to time an entry and exit into these assets. Multi-asset funds gives a framework to invest in all these assets, and an experienced fund manager can carry out rebalancing of assets based on inflation and other economic conditions. They also invest in commodities such as gold, silver, and even crude oil, because high inflation means higher commodity prices. When inflation cools off, asset classes start performing differently. So these multi-asset fund managers can adapt and manage the rebalancing dynamically with no impact of taxation to the investor. The inflation cost in the early 20th century was due to the world wars. The current inflation is related to the excessive fiscal stimulus, and the loose money policy have a few good ideas to combat high inflationary cycle. Every time there is a recession or inflation, people dump stocks. Follow a system to be successful rather than falling in for emotion. Keep holding on to good companies, good businesses, and wait, because you get rewarded when you buy really good companies and you're patient. If you like the content of this video, please do like and share it with your friends. Consider subscribing to this channel, as it really helps with the YouTube algorithm to reach a wider audience. Thank you.